Hello again and welcome. My name is Bradley McLean and I'm co-founder for Regulation Asia. Last year, the Basel Committee on Banking Supervision issued a discussion paper that received strong industry reactions. On one hand, the industry supported the steps towards greater regulatory certainty, but on the other hand, many participants felt the treatment of crypto was overly conservative and designed to hinder banks' participation in the ecosystem. Now, joining us today in our session to discuss some of these issues is Bill Cohen, the former Secretary General of the Basel Committee and current chair of the IFRS Advisory Council, and a board member and valued advisor for several prominent firms in the financial industry across the world. Welcome, Bill.
Thank you, Brad. Always a pleasure to speak with you. Thanks for inviting me today.
Not a problem. To kick things off, I wanted to, address the elephant in the room. Last year, as I mentioned, the discussion paper received strong reactions, to say the least. I wanted to just quickly get your thoughts on the approach taken in the paper. From your perspective, was it too conservative or a more fair and balanced approach given the risks?
I think it's important to look at the progression. I left Basel in the middle of 2019, and right before I left, the Basel Committee issued a newsletter. So there are varying degrees of these communication devices that the Basel Committee uses, and a newsletter really is just exactly as it says. It's this is something that we're thinking about, and here are our thoughts. And that was March 2019. That talked about crypto and due diligence that is expected by the supervisory community, the governance, the risk management elements, disclosure, and importantly, supervisory dialogue. It was the middle of 2019, a discussion paper, was issued. And that represents a kind of a ratcheting up from a Basel Committee perspective of its thinking. But that's a device that isn't used too often. For example, the Basel Committee put out a sovereign discussion paper on the treatment of sovereigns, and that's typically when the thinking on a particular topic like crypto or like sovereigns is really in the embryonic stages. But it's important to get it out there and just to start getting reactions. And then so the next step in that progression was June of last year, when a consultative paper was issued. And then you get a little bit more specification, what the Basel Committee is thinking. It included the capital treatments. And that really just, that this is the typical progression. But in the case of crypto, I mean, this is really interesting because it's moving so quickly. And it's somewhat compounded by the fact, or it's made more complex by the fact that there's not good data. So this is something that's moving quickly, and I think the Basel Committee is moving commensurately rapid on this. Now, Brad, you asked a moment ago, did I think that the proposals were overly stringent or fair or unfair? No, I think it's no doubt conservative. I think the Basel Committee even called its proposed treatment conservative. But that's no surprise given the newness of this asset class. There's not good data, as I mentioned. There's not a lot of experience with managing this particular risk. So I would expect nothing else than what has already been published. One last thing, Brad, important to note that the Basel Committee acknowledged that this is an iterative process. On the discussion paper, they received a decent number of comments. If I recall correctly, 40 or so. They've got comments. They're making an effort to try to collect data. And so this is truly an iterative process. I would expect another consultation paper before the committee finalizes its standard.
Walk us through the process, obviously discussion versus consultative paper to whatever goes next. You'd also quickly touched on, the data gaps. It is obviously a new asset class and it is evolving very, very quickly. But from your perspective, what do you see are the main concerns from regulators about banks being directly engaged in the crypto markets, whether that's engaging with crypto clients, exchanges, or even from a principal perspective?
I think in both the discussion paper and the consultative paper, the Basel Committee set out the number of risks, and they're not only bank-specific risks. Of course, there's credit market operational, reputational, legal, the traditional, if I can call it that, the traditional risks, but those are the bank specific, the firm specific risks. And bear in mind, the Basel Committee is housed at the Bank for International Settlement, as people like to say, the central bank for central banks. And so the other consideration here is financial stability, market stability. What are the broader implications of an ever-growing asset class like crypto? So I think those two things, the broader market implications plus the lack of experience with the firm-specific risks. This is really a unique asset class, a unique regulation or standard that the Basel Committee is trying to come up with.
So you'd mentioned the implications. I just want to flip that for a second. I mean, what would you expect if the impact would be on crypto asset markets if this approach was adopted?
Oh, I think they would. It is conservative. So I've got a couple of reactions. One is, well, at least it's not banned outright. I think a lot of stakeholders, a lot of participants in this asset class were afraid that the Basel Committee is going to come out and say, you know what? We don't think this is a good idea for anyone, for any banks, for any jurisdictions. Well, that hasn't happened. And I think that's absolutely the right move. The Basel Committee and the central banking community is very much in listening mode. So I think that's, as a very basic starting point, I think that's the right direction. It hasn't been banned outright. Now we've seen it banned outright in some countries. China, Russia has, maybe not explicitly banned it. Turkey, Saudi Arabia, it's not really very much, for many countries, it's not in favor. But from the Basel Committee perspective, from the global perspective, it hasn't been banned outright. Now, but that's not your question. The question is, so how would it affect the market? I think the market would adjust. If there's demand, that demand will be met by, say, non-bank players. And then the regulators need to ask themselves, are we okay with this activity being pushed to the non-regulated sector? And what are the implications there? We learned quite a bit during the global financial crisis, the perils, the hazards, if you will, what we call then the shadow banking sector. Now it's the non-bank financial institution sector. So, and that raises a whole new set of policy issues and policy challenges. But I do think the demand will be met, except not by banks, if they view the regulatory constraints to be unduly punitive or just not right for their business model.
Okay. I think it's important to note that in terms of the banning, I mean, we're differentiating, I guess, between banks and overall banning within certain markets. And different countries have different perspectives, whether or not they're allowing banks to engage or the wider kind of markets to engage. You did mention, though, two things previously. One, this is an iterative process, but two, Basel's in listening mode. I mean, based on your experience, do you expect that the regulators, Basel, I guess, to adopt the current framework, or are they likely to adopt a less stringent approach to crypto assets when they settle on the framework? What are your expectations? And in terms of timelines, do you have anything in mind?
Well, the one thing I would be very surprised at, and this is not earth-shattering view, I would not expect the Basel Committee to come out with a more punitive approach. It never moves in that direction. You consult hard, and then based on comments that you receive from the industry, from all stakeholders, based on empirical analysis like a quantitative impact study. Well, then maybe there's an argument to draw it back a little bit. But I was in Basel for 20 years. I can't think of an instance where the Basel Committee actually came out with a standard that was tougher than the standard, than the proposal. So, I do think they are very much in listening mode. Things are moving so quickly. This is a an emerging technology, innovative technology, disruptive to some, but I think the Basel Committee and the central bank community largely view this as, as innovation. I think people make the mistake of, when they think about this, the treatment proposed by the Basel Committee, they think, wow, the treatment for crypto assets like Bitcoin or Ether and the others was really punitive, but that ignores, the proposed treatment for tokenized assets or, stablecoin. So there was a lot in the discussion paper, a lot in the consultative paper. I think they are very much in listening mode. I know how the process works when it comes to looking at comments. There'll be a debate around the comments. What are the key themes? What are the takeaways? So, no, I think that is. I think they're following. They're doing exactly what I think is the right move from a policy making perspective. As far as timing, now this is interesting because it is moving quickly. The market continues to grow, and uncertainty is never a good thing for anyone, particularly banks, but also the supervisory authorities and the central banks. Certainty here is important. I do think that there is a strong desire in the Basel Committee to come out with another consultative paper, I would say before the end of the year, if not the next couple of months, to provide that certainty. Now, people may not, people may disagree with the proposed treatment, but at a minimum, it provides certainty, and that's a good thing. So I do suspect there'll be another consultative paper. The minimum consultation period, the comment period, is 90 days. It's rare that it is less than that, so I would expect another 90-day comment period sometime in the next couple of months. Whether or not they could finalize something by the end of the year could be a challenge, but I do think that it's very much moving in that direction. And Brad, one last thing. All this focus on regulation, and I know I sound like a broken record when I talk about regulation and standards. I know how important it is. I devoted a significant part of my career in doing just that, in helping set standards. But there's a whole world outside it. There's risk management, there's the enforcement of the standards, there's disclosure, governance, and everything else. That I don't think the committee has overlooked that. I think there's quite a bit of discussion on those issues. Bank supervisors talking to management and boards of banks. Are you considering the risks? What's your strategy? What do you think is the right amount of capital to maintain against these exposures? So let's not forget that side of it, because I think that's equally important.
So as we look to the future, would you anticipate that the next phase of the consultation to be more focused on regulation or supervision?
Maybe BCBS 239, the risk data aggregation and risk reporting, maybe that's, a good example here. That's something that wasn't even, in Basel Committee lingo parlance, that wasn't even a standard. It was guidelines. But what was important, and that had a tremendous impact, and why it had such an impact was the committee put out some regulatory expectations, and then critically it went back, followed up a year later and said, okay, so these were the expectations for those 11 standards that are pitched to the banks. Are you adhering to those standards? And there was a handful also that were targeted to supervisors. So I think that was a really good example, and I could see something similar here. You've got the standard, but there's the supervisory, the oversight aspect of it, and following up with banks, and really maintaining that supervisory dialogue that is so critically important. I could really see a case for doing that, particularly because things are very new and things continue to evolve pretty quickly.
You mentioned you've been in Basel for 20 years. You've obviously looked at numerous developments over the years. I mean, this proposed framework, is this the strictest you've seen so far, or can you recollect something that's been a little bit more conservative and potentially watered down over time?
Well, everything I worked on was, it was credit risk and market risk. I was there when the Basel Committee first consulted on an operational risk framework. Operational risk wasn't new, of course. It just wasn't part of the regulatory capital framework. This is new. To answer your question, I really don't recall a situation in which we were faced with this unique set of circumstances. I guess the other interesting parallel is climate risk, in that they're similar in some respects, that there's not good data. The risk management of climate risk hasn't advanced, similar to risk management of crypto. So it's interesting that those two are so topical these days, and there are some unique parallels. So I think it's safe to say, no, I have not experienced something like crypto or climate, and trying to, from a policy perspective, trying to set a standard for both of them. They are unique, topical, moving quickly, of great importance to not only the banking industry and the regulatory community, but also to politicians, to citizens, and to all stakeholders. So that's I guess I could draw that one parallel: climate risk.
I mean, in your view, and I guess this is putting on your former hat, I mean, should banks be able to hold proprietary positions in crypto or on behalf of clients?
Right. I used to be a long time ago. I used to be a banker, and so look, I think I have a fairly liberal view here, that and people might be surprised to hear that, when it comes to risk taking, well, this is what banks do. First of all, supervisors love that. Everyone wants profitable banks that serve the real economy. I have no problem with banks being in this space as long as they've thought it through. They've got a strategy. They know what they've evaluated the risks fully. They maintain capital to fund what could be some very risky exposures. So, no, I certainly have. I have no problem with banks being involved in this space, but there are a number of caveats around that, like the ones I've mentioned.
Okay, so basically the answer is yes, but.
Yes,
there's
but.
a lot of other things to go with, right?
Yeah. Well, yeah, but it's that way with any risk. Yeah, sure. Banks are in the business, to take risk, and there's a lot around that. Banks have a unique role in the economy. In the economy, they have in many cases they have deposit insurance. Some people believe that too big to fail is still a factor. Banks have relatively low cost of funding. So banks are unique. So I think it would be crazy just to say, sure, a bank, jump into the space, you can make a lot of money. No, there are some risks, and as long as a bank management, their boards are fully cognizant of those risks, are prepared to take them, and if things don't go as they expect, as long as they're protected in terms of capital, sounds good.
I just wanted to kind of switch, pace a little bit up and kind of discuss stablecoins for a second. I mean, from USDT to USDC through to the now defunct Facebook, Libra. Stablecoins have been in hot seat for a while, but many still consider them an integral part for crypto innovation. From your perspective, I mean, what lessons can be drawn from these recent experiences? And are there any vulnerabilities concerning stablecoins from a prudential perspective that still need to be addressed?
On the lessons learned, I found the Libra experience fascinating, because this was something that Facebook was going very quickly down the road. I think they did a lot of things right. They had a lot of stakeholders. They had a lot of people involved in the formulation of their product. The one critical mistake, in my view, that they made was they didn't sufficiently socialize it with the official sector. I do remember well. I was in Basel at the time. I do remember well when it was published, and there was it was a surprise to many, and I think they could have. I think if they had taken the very simple step of approaching some central banks, some supervisory authorities, people in the official sector, I think if they had done that, first of all, I think they would have been warmly received. I think there would have been some very helpful questions. Have you considered this? What about that? It would have only led to a better product. They didn't, to my knowledge, those crucial steps were not taken, and I think that ultimately led to its to its demise. So I think that lesson has been learned and observed by others. I see that particularly in the payment settlement system space. There's a lot of innovation going on there, and I think the official sector, and I'm talking mainly about those who've got oversight authority to payment settlement systems. I think they're eager to listen to how these developments work. They ask the right questions to the firms that are developing these innovative technologies, and I think so. I think in a way the whole Libra process has led to a better process for other products now that are under development. As far as stablecoin, Brad, this might sound like a cop-out, but I don't think we've got enough experience yet to say, these are the risk factors. This is the outlook. I just don't think we have enough experience yet. Us in the official sector. I'm also now, I do a lot of work in the private sector. I don't think the private sector has, the regulated private sector has sufficient experience to weigh in here. So I think it's something that I know everyone's watching carefully, but I just don't have a good answer because I don't think there's enough experience at this point.
So I guess just too early to tell. From there, if we don't have enough experience on stablecoins and given the rise and focus on CBDCs, what is the potential from your perspective on stablecoins? Will they become redundant, or are they solving a unique problem?
No, I think there's a role for them. I think it's been demonstrated. I think the Basel Committee discussion in its consultative paper from last year, when they talked about stablecoins, I think there was a really good acknowledgement that there is a role for them. So I know from the official sector perspective, there's more acceptance of stablecoins. It's hard for me to foresee what the path is and how broad it will be, particularly, as you astutely observed in the context of CBDC. CBDC is a whole other story. We're getting some experience with the Chinese banking system. It's still kind of early to foresee what will be the direction of travel in Europe and in the U.S. and other jurisdictions, other large jurisdictions. But the relationship between CBDC and stablecoin, interesting topic. I don't have the answer for that.
Okay, well, maybe that's a chat for another time once we've had a little bit more data under our belts. With that, unfortunately, we're out of time. Bill Cohen, former Secretary General of the Basel Committee and current chair of the IFRS Advisory Council, thank you so much for being so generous with your time today.
Always a pleasure, Brad. Thank you again.